Hi everyone, this is Pete here. Now the yield curve has finally inverted. Does this mean we're going to see a market correction or even a bear market? And more importantly, when is it going to happen if it does? Let's take a look. For those of you who are new, what exactly is a yield curve inversion? Now, I believe most of you right now, when you look at this picture, it'll be the very familiar one. And that's basically when the long-term bond yield is actually yielding less than the short-term bond yield. And in this case, we're comparing the 10-year bond to the 2-year bond. Now, more importantly is this. Understand what happened in the past when the yield curve inverts. Okay? So in 1973, we had a very interesting phenomenon. Usually, the inversion will take place before the market peaked out and start to drop. However, in this case, in 1973, it was the opposite. The market actually had a peak before the inversion. Now, in 1978, we saw something that's more normal, right? The inversion took place in August that year, and the market only peaked out about 17 months after that in February 1980. Now, in 1980 itself, we had another inversion this time around in September, and 2 months later on, the market reached its peak and started to correct itself down, forming a bear market. Now, in 1988, this is where it gets interesting. We saw the inversion in December that year. However, we did not see any market top until July 1990. And that means the market ran for another 34%, 19 months before the market peaked out. Now, in 1998, we saw that the market ran for another 22 months, right? And 40% more before it peaked out after the inversion. Now, in 2005, the inversion took place in December. However, it never took place for the market to peak out only in 22 months later on and after running for another 22%. Now, more recently in 2019, we saw that the inversion took place in August. And of course, we had our famous COVID market crash in February 2020. And during that period, the market ran for another 6 months and another 18% more. Now, what does the history tell us? If you look at all these past inversion dates, right, on average, you have about 18 months after inversion before you can see the market peaked out and start to drop. And if you exit right now, there's a likely chance you're going to leave on the table about 20% of profits. Now, as everybody look at the inversion, the important thing is this. While we are looking at one particular yield curve, I am looking at another yield curve. Now, what is this other yield curve? Is that if you don't compare it to the 2-year bond yield, but instead you compare it to the 3-month bond yield, it looks very different. You can see over here the rates are actually widening when you compare the 10-year yield with the 3-month yield. In fact, it is increasing, right, ever since the COVID crisis in 2020. Now, why is that the case? Why is the 10-year to the 2-year so different from the 10-year to the 3 months? And that is because of the difference in the 2-year treasury yield and what we call the Fed funds rate. Now, the Fed funds rate is basically the exact rate that the Federal Reserve imposed on bonds, and right now you can see the blue line, it is still heading upwards because they only corrected one time of 0.25%, right? Whereas the 2-year bond yield has already factored in all the potential rate hikes right now. So the 2-year bond yield is actually very sensitive to any mention of Federal Reserve rate increasing. And right now, the 2-year bond yield has already factored in 10 hikes. Now, another factor you want to take note of is that since the Federal Reserve has been buying back bonds so aggressively for the last 2 years, right, we are actually seeing a lower than usual yield on the 10-year treasury bonds. So the 10-year yield, it is very likely to rise once the central bank started to stop buying back bonds and shrink their balance sheet. Now, you can further see this if you look at all the current yield, and you can see that the 3-month bond yield is only at 0.533%, right? Whereas the 2-year bond yield is at 2.479%, almost a difference of 200 basis points. Now, with that said, it doesn't mean that we will not see the market correcting. And that's because we do expect interest rate to go higher. And if there's a higher interest rate, when you look at this, the correlation is that a higher interest rate does bring about lower PE multiple, and that generally means lower stock price. Now, why do I believe that we are going to expect higher interest rate? And that's because the economy has been very strong. Now, the economy just added another 431,000 jobs in the United States, right? And just in March itself. Now, the employment has further ticked down to 3.6%. This is well below the 4% that the Federal Reserve was targeting for. And with close to full employment, this means that there's going to be a bit of upward pressure on the wages as employment tightens. Now, with a good economy when almost everyone is employed, and to make sure that the wages do not increase beyond what they can control, this gives Federal Reserve some leeway, right, to raise rates as the employment is really strong right now. So, I want to end off on this last slide, and is this, right? The year 2022 is the 6th worst start to a year, right? But how about the other 5? How did we do after we suffered a worse start to the year? And you can see overwhelmingly for the first 5, right, 4 out of 5 we actually had a positive end of the year. And they are all in very nice double digit, ranging from 28% to as good as 66%. So this means that if you are still investing right now and you do not pull out of the market, there's a fair amount of chance your return on average is going to be about 36%, and your odds of success is actually better than a coin flip at 68.1%. So I want to bring up an old adage by our very famous Warren Buffett, and he says this: be what when everyone is fearful? So if you know the answers, put in the comments below, and I guess you know what I'll be doing, and I'll see you guys next time. Bye!